Welcome to Chapter 6 of Mercury Investors Trading Program. Abdul is going to be going over the different types of ways you can manage trade. Enjoy.
So in this video, we'll look at when to enter a trade, risk management, when to close partial profits, when to fully close a trade, and where to set your take profits and stop losses. So let's get straight into this. When do you actually enter a trade? Well, after you've done the following and checked them off your checklist, you should look at entering a trade. So firstly, you should have prepared your setup. You never go into a trade but blindly. You need to know what you're trading with and why you're trading. Next, you're happy with your confluences. Your confluences, what backs your idea? What makes you think you're right? Once they're satisfying you, you look at price action for your entry. So once price action is signifying that you could be in for a good trade here, you identify your stop loss and potential profit levels. And then once that's done, based on technical analysis, you measure your risk using a calculator, but we'll get into that a little later. So where do you set your stop losses to begin with? Well, that purely depends on what you're trading off. Some people will trade head and shoulders patterns, resistance levels, and retracement levels, as well as trend lines. So that is going to dictate where you set your stop loss. The textbook way of setting your stop loss when trading a head and shoulders pattern is if you're entering off the right shoulder, you set your stop loss at the head. So just like this, you have your right shoulder, your stop loss just beyond your head. And some traders are a little more aggressive. They'll set tighter stop losses, but this is the textbook way to do it, and this is the way I prefer to do it. So stop loss using resistance and support. When placing a stop loss based off these levels, you should always place your stop loss just beyond the level to allow room for reversal. It would be impractical to have your stop loss on the actual level, as it's likely to tap it if price comes near, because price is almost magnetized to trend lines, support lines, and resistance lines. So here's an example of using support or resistance with stop loss. So here you have a resistance level at 1.27569. You have a downward trend line, and you're entering on the third touch. If you have your third touch, you're using this as your reference for the stop loss. And this is exactly why you don't put your stop loss on the trend line, because it would have taken you out pretty much straight away. Here, if it didn't take you out the first time, it would have taken you out the second time for sure with a big wick like that. But you see there's still a comfortable amount of room there before it comes down, so it doesn't even come near my stop loss. So here, you see, if you'd been taken out, you would have been missing out on all of this profit, and it just kept going down from there, in fact. So, using stop loss on a retracement level. In terms of this, you should treat the retracement level as if they were support or resistance. So if you're to enter on one retracement level as a buy, you'd use the retracement level below as your reference. So here's an example. I've entered on 0.382, or 38.2% retracement, and on the third touch of the trend line, and I've set my stop loss just beyond that, the 0.5% retracement or 50% retracement. And you can see, well, I didn't really need it, but that was the right way to do it. In terms of 0.618 or 61.8 and 78.6% retracements, these are often the best levels to enter at, because if they go beyond that and close quite strongly, you know it's a full reversal and it won't be a retracement. So you can use those as your reference for a stop loss quite a lot of the time as well. So stop loss using trend lines. So in terms of using a trend line for your stop loss, you should just treat the previous touch as your support or resistance level. You place your stop loss just beyond the previous touch to allow space for a reversal, just like here. So here's your entry, your third touch of the trend line. Your second touch is here, just below, and you place your stop loss just beyond that, so there's space for it to come back if it goes into drawdown. But in this case, once again, it didn't need to, and it just pushed up into a nice profit. So when do you take money out of the market? When do you take profit? You should always measure your profit levels using technical analysis, and you should do that before, so you know if the trade is actually worth it. Unplanned withdrawals of profit should be based off price action, and that's understandable because sometimes the market can be very, very unpredictable. Also, you can also trail your stop loss, and occasionally you will get stopped out at break even or in profit should you trail your stop loss. So taking profit. I've highlighted the zones that I took profit on this trade, and these are because these are support or resistance levels that are held quite nicely. And like we said in the support and resistance video, you can see price breaks through this resistance and comes back and tests it as support. So upon this happening, you'd be thinking maybe now would be a good time to take some money out of the market just to secure some profit. Make sure that I have something to take from should this come back and take me out of break even. So this is a nice trade setup, almost identical to the Euro US dollar one on the Fibonacci video, Fibonacci slide. As you see, your trend line, first touch, second touch, third touch, you would have had Fibonacci on this, I believe, and a resistance level right there, or support level in this case. So on to the next slide. We'll go on to risk management. Risk management is the most important thing when trading. It means that your losses remain constant, but your winners can always be more. If you maintain a good risk to reward ratio, you ensure that your winners are bigger than your losers. And who doesn't want that? If your winners are bigger than your losers, you'll always make profit. And should you not make profit, it's because you're losing a lot of the time. Most people stick to their regular 0.5 to 2% of their account for their risk. For example, you trade with a $10,000 account and use 2% risk, you're risking $200 a trade. And with a 3-to-1 risk-reward ratio, you'll probably return around $600 profit once it's all closed. So how do you know what lot size to use? Well, once you've measured your stop loss, you should go to the MyFXBook website where you can find a calculator that will do all of this for you. So you simply put in how many pips between your entry level and your stop loss here, your risk percentage there, your account balance there, what currency you're trading with there, and the currency pair you're trading there. You press calculate and it does it all for you. And here's an example of one I took, and it said 0.57 lot size as here. So why do you move your stop loss? You should only ever move your stop loss once you're in profit. After traders made a push into profit of maybe more than 30 to 40 pips, you should always think about moving your stop loss to your entry price just to protect your capital, because the market can move against you really quickly, especially before you go to sleep. At this point, your trade becomes risk-free and you can't lose any money even if your stop loss is hit. As the trade goes further into profit, like I mentioned earlier, you should always trail your stop loss to secure profit. For example, if your trade is now in 100 pips profit, after the next pullback and push, you can see your stop loss move to 50 to 60 pips profit. So in chapter 7, we'll be looking at putting all of the things that you've learned together and looking at a few examples of trade. We appreciate you for watching, and we hope to see you in chapter 7. Thank you.